Hi, I'm Patu from freefincal. A couple of days ago, I had talked about list of equity funds that fell the most and fell the least this market crash across a 32-day window. We'll take some more specific results from that article and have a look at that today. Before we begin, Venkatesh Jayaraman has shared his fourth ebook based on his experience of handling the 2008 crash, facing the market carnage in 2020, how this is an opportunity for investment, how sectors are expected to behave in the future, and so on. Please download the ebook by going to freefincal. That's the latest post out there. So let's take a look at these numbers. So this is an active mutual fund market crash report card for some mutual funds, and we're going to look at the performance of the fund between two specific dates: February 20th 2020, just before the market fall, and March 23rd 2020, that's the current bottom of the market. And this is a 32-day window. I don't claim this to be any great analysis or something. This is just an information, if not an insight into how active funds are performed against some select indices. A lot more information is possible across other categories. I'll write about some of it maybe tomorrow, maybe in the coming days. I don't want to say anything for or against active funds. This is just information given to you. You will have to process it. My suggestion is don't start saying, oh, index funds are better, oh, active funds are better. That's not the kind of dialogue or discussion I want. I'm just looking at the funds at a particular interval. I'm not claiming anything, I'm not making any analysis. Let's see what this I will leave the interpretations to you. Please don't choose or reject your mutual funds based on this information. So we want to look at the absolute return between these two dates, and so that's February 20th to March 23rd 2020. The Nifty 50 fell 36.85%. The Nifty next 50 fell lesser, it's just fell 35.3%. That just tells you the kind of inhomogeneity in the market. I'll talk about that in detail. The top 50 stocks, the top 5-6 stocks of the Nifty were driving the Nifty forward. That is no longer the case. There is I think to a large extent the inhomogeneity in the market has been corrected, and you can see that the Nifty next 50 has actually fallen almost a percent less, which is amusing. The Nifty small cap during this window fell 42%. The mid cap 150 fell 38%, and keep that in mind. And we will have to let's see what happened to the slide. The slide is huge. Oh, so this is where it went. Let me just go back here. All right. So we're going to look at the fall of 33 large cap funds, and remember Nifty 50 fell 36.85%, Nifty 100 fell almost the same, 36.64%, and out of those 33 large caps, only 5 large caps which are mentioned here: HDFC top 100, Tata large cap, SL large cap, Nippon large cap, DSP top 100. Only those 5 large caps fell more than the Nifty 50 or the Nifty 100. The remainder of them fell less, of course, close to it, 36, 30, a little bit more, a little bit less, but so on. But it technically, for the record, it fell less. Coming to the mid cap section. There you go. The Nifty mid cap 150 fell 38%, and pretty much all the mid caps, every existing mid caps fell lesser than that except one, which is Sundaram mid cap. Except that, everything else fell lesser. Please be careful while choosing mid cap, small cap index funds. They can be a little crazy during such intense volatility. Please recognize mid caps can hold 20% of large caps, and that can work in their favor during such time. So please, my suggestion is please avoid index funds in the mid cap, small cap segment. And if you look at the small caps, the small cap index fell 42%. That's 250 small caps fell 42%, of course market cap weighted. and all the small caps fell lesser than that. So please recognize. I think if I'm not wrong, when Motilal Oswal came, I think there were a lot of takers for the small cap index. I'm not sure that's a smart idea. Um, uh, in, if there is one category where active management plays a very important role, it has to be the small cap universe. Don't blindly follow the index in the small cap. It can just be counterproductive. Over long years, it will do nothing. It just go up like that, zoom up and zoom down. Nothing else will happen. Better to stick to, if you want small caps, stick to actively managed small caps. My suggestion is don't use small caps. There's no need for them. Use a good multi-cap fund that will give you enough small cap exposure. All the small cap that you need in your portfolio. So that's what I wanted to say. This doesn't mean that index funds are bad, active funds are good, or something like that. We will explore more categories in this. There are a lot more interesting insights on risk and reward. I'm just giving you an insight on the risk management. Forget about the reward, for there's no reward here. But then you must understand what you're in for, and you must be careful when you handle that. Again, in the small cap category, that 20% can be a combination of mid and small cap, mid and large caps for the small cap funds. So that can prevent the fall. Of course, in this market, in this particular market crash, especially the small caps, on the mid caps have fallen almost as much as the large caps because of the inhomogeneity. So we will take a look at the other categories later on, and we'll also explore the market inhomogeneity and how I think it's almost more or less reset because of this carnage or